Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors, or in such capacities, licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in today's webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By access to this webinar, you agree to hold yourself harmless from any losses you may incur as a result of the information discussed in the media identified above. By access to this webinar, you agree to be placed on a mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. That is some exciting stuff. All right, moving on. All of a sudden, we got a big pickup, and I don't know why. I don't see anything that actually happened. Hang on, I have one bit of housekeeping to do. I forgot for the poor people of Seeking Alpha. Oh shoot, what is it? I forgot to give them a link to the webinar. Hang on a second. Yeah. See, so many different things to do in my day. Oh, I didn't tell the people here. Okay, hang on a second, because if nobody's on the webinar, what's the point? Sorry about that. Okay, sorry, now we're all caught up. So anyway, so there I was minding my own business, and all of a sudden the futures popped up on us, and I don't know why. Does anybody know why? Speak up if you do. Let's see if anybody has an opinion on that. I haven't seen anything yet. Recording, yes, thanks. Appreciate it, Jim. All right, nobody has an opinion. All right, fine. So let's take a look and see if we can figure it out. We'll go to, let's Seeking Alpha and see if they have a thing in their news. News. Here you go. Ew, what is this? Ew, what is this presentation? It's awful. Oh. There we go. Okay, that's better. All right, so step number one, if you're trying to figure out what happened, is first of all, when did it start? It started right at noon, pretty much. We had a sharp turn up, and now we take a look and say what's happened around noon that might have caused something like that. So go back to 11:30 for good luck. So we know about Cooperman saying he's in trouble with the SEC. Damn. The stupid thing doesn't stay put when you're looking at it. Wells Fargo says Exxon didn't do anything wrong. Who are they to talk? I guess when you're guilty, you look at everything. It's like thieves, right? You're like, nah, he's fine. He didn't do nothing wrong. Why are you bothering that man, officer? Facebook partnership, who cares? Consumer goods, Virus, what? Virus? Oh, that's the thing. ETS, Disney says Adobe at all-time highs. Disney's IGO. See, my daughter's smart. She picked the third time she ever picked a stock. She picked Adobe and she retired. She picked Adobe when it was way down at the bottom. She wrote this article about it when she on a Take Your Daughter to Work day, like a few years ago, and it's more than doubled since then. And I keep telling her to do more, and she's like, I don't want to do more. I won't do. She's like, what's the chances I get another one like that? And she's right. It's a great way to retire. She's got 100% accurate record, and has returned over 100% to investors. It's a good trading career. Let's see. Shanghai quality. Disney. Poor Disney. We like Disney, but they're not catching on. Goldfields, Nexstar, Apple, McLaren. I didn't even comment about that. I saw that before. It was like some rumor that Apple was buying McLaren. I'm like, why would they buy a company that only makes supercars? You know, unless Tim Cook wants a McLaren, what's the point? Because, you know, how many cars are they possibly going to make? I don't think McLaren makes more than like a few hundred cars in a year. It wouldn't make much sense, would it? It's so weird. I mean, the way they put it, and McLaren's like a $2 billion company. They make a few hundred cars a year, but those cars are like $1 million each. Really crazy stuff. Anywho, so no particular reason for a bump up. Just we're getting closer to the Fed, and I imagine that the people who thought the pessimists got out and the optimists are now coming back in. And basically all we're doing is drifting back to right where we were before, so what's the difference? All right, we had a nice little call in the morning. We made a little bit of money on the short side. And now we're going to have to wait, though. You can't gamble this. So, I mean, I hope everybody stopped out. We hit 16.5 on the Nikkei. That was a nice 200-point drop. We had really good numbers. Well, I said so, in fact, when it was turning, didn't I? You know, these are... I can't come through the monitor and smack you guys around, but I mean, frankly, right here, 1234. Okay, I said we're ready already. We'll cash in our shorts ahead of the Fed, not worth the risk, and those were the stops. All right, so 16, in fact, dead bottom on the Nikkei, probably dead bottom on all these guys. All right, it's not hard, guys. I mean, just, you know, don't be greedy. Take the money when the profits come. Oh yeah, it was late on it. It says 12:30. And all of a sudden, so I called it here in the middle. When see, this is the thing. When you have a big move, and then it stops, and you run out of momentum, and you're coming into something uncertain, which is the Fed is going to be very uncertain in a very short amount of time. You got to take it off the table. Okay, you can't. It's not worth the risk. I mean, yeah, it'd be lovely if it goes down further, but you know what? Look at this is 18.1 to 18.040 is 60 is $300 there. There's 6 times 50, $300 there. Here's I don't know where we started in NASDAQ, frankly, so I wouldn't say. Obviously we started shorting in the morning. So 20 to 95 is 25 times 20 is $500 there. The Russell, of course, as usual, is a big winner. So we short that from, I think we like them at 30 short, frankly. So 30 and back down to 25 is 500. So $300, $500 gains. You know, the Nikkei being actually the best one because it went $200, 200 points down is a $1,000 gain. So the Nikkei was our best performer. And I'll show you where we started this trade. What we do every day in chat. Well, not every day, because frankly, if there's nothing to trade, I don't make a trade. I mean, I only call them out when I think there's a high probability of success. So this morning, which I do pre-market, this I do every morning pre-market. I always go over what I'm reading. I used to just read stuff and then write my article, and then it occurred to me, I'm like, well, wouldn't people like to know what I'm actually reading about so that they can understand why I'm writing my article the way I'm writing it? So now I sort of like take my notes here instead. I used to take my notes separately. I'm like, this is stupid. I should take my notes right here. So I said 2140, 18125. Oh, it's better than I thought. 4825. Oh, wait, a little better than I thought. All right, well, it doesn't matter. We made money. Are exactly where we were yesterday, so we have a rate set by the trade box ahead of the Fed. It's a lot more dangerous to short, though still fun if you're careful. Very tight stops above. That wasn't really a problem. And the Nikkei blasted 16.8, 16.7, and now we want to short there. Not complicated. It's like we're playing the same lines every day. No, here's a good one. All right, so this is what they call the dot plot. And this is where, based on the Fed governors' projections, where they all are as far as what they think rates should be. So, so what's her name, who was dovish last week? She's probably this one. So, one person thinks we should be at 0.5 forever. The majority think this year, now see, here's the funny thing. The majority think 0.75-ish. So the majority think we should have a hike this year. And again, this seems to be the only time they can actually do it. Next year, they're looking for 1.5. That is a freaking shock compared to where we are now, which is 0.5. Okay, we're here, and they think we're going to be here. That's 4 hikes next year, 4 quarter-point hikes next year. Another 4 quarter-point hikes next year, and then a couple after that. That's 10 hikes. Bada bing, bada boom. That's a lot of hikes, okay? So that's kind of like when Volcker started tightening. It's a relentless, constant raising of rates. That's what's expected. So why is everybody freaking out about the fact that they might tighten once now? It's 1 in 10. It's the whole concept, and this is what I'm talking about, because if people are freaking out about this tightening, the first of 10 ahead of us, what's going to happen for the next 2 years of tightening? Are we going to just go through this all the time? Is this going to be the way the market reacts every time they tighten? It's crazy. And the reason that's happening, though, is because this is the problem. It's not baked in. Okay, the fact of rate hikes is not baked into the price of stocks. And that's why I'm very uncomfortable playing the long game on stocks right now, because the market has not accepted the reality that rates are rising. If it had, it wouldn't freak out about a single rate rise. If you accept the reality that we're raising rates 10 times over the next 3 years, you wouldn't freak out about one raise, right? Like, let's say, it's like a doctor telling you, like, okay, I'm going to have to give you 10 shots. And you're like, oh my God, 10 shots, that really sucks. But at least he told you. And then he gives you 1 shot, and you don't go, and then he gives you 1 shot, then he comes back to the second shot, and you don't go, oh my God, another shot. You know it's going to be 10 shots. Okay? It's when they don't tell you that it's a problem, that you didn't plan for it, and you didn't think about it. Then you're surprised every time. And he comes back after 2, he didn't tell you it was 10, he comes back with a 30. You're like, third, what are you kidding? And you go through it over and over again. That's where the market is now. The market's acting like nobody told them rates would ever rise. Every time, it's like, oh my God, are you kidding me? How can we be raising rates? Even the freaking people in the Fed are saying that. You even have Fed governors who are saying this. Oh my God, who's raising rates? What's this about? All right? This is not natural. In the course of human history, this is not natural to have rates this low. Obviously, it's not natural because you, yourself, would not take the money you have in the bank or the money you have in the markets, and you would not take your $100,000, $200,000, $500,000 and give it to someone for 5 years and say, oh, pay me back 1% interest. Just hold my money for 5 years. Send me, here's $500,000. You send me $5,000 a year. You do what you want with it, and I trust you to give it back to me at the end of 5 years. No worries. Just the $500,000 plus the, so I'm only getting $525,000 for my $500,000. You know that you expect better opportunities for your money. You know you expect to do better with your money. You know you need to do better with your money than making 1% for 5 years. All right? Just because it's a bank or a IRA account or a lending institution or whatever, just because it's a bigger scale, because it's a fund, a hedge fund, it's this or that, just because there's $1 billion involved and not 500,000 involved, doesn't change the dynamic. People have money, they have to put it to work and they have to do something. If you have your money in a hedge fund, they're taking 2%. That's the management fee. They're taking 2% no matter what happens. So if they're putting in, can you imagine would you give your money to a hedge fund manager? You take your money and puts it in a thing that gets 1%? No. You're guaranteed to lose 1%. But of course, and there's the fallacy of negative rate bonds. You give money to a government that gives you a negative rate, you're guaranteed to lose money. Guaranteed. We promise we'll give you less money back than you gave us. It's not just that it's stupid, it makes no economic sense. And you can't continually run an economy that doesn't make sense. You have anything short-term, things cannot make sense. Long-term, things eventually have to start making sense. And a lot of people will tell you, like, don't confuse economics with math. Economics is not math. Economics is a social science. There are no laws of physics governing economics, but there are. There are laws of physics governing money, because money is a finite thing. Okay, so if money is a finite thing, there's an X amount of it in the world, there's X amount of places the money could go. You can create more money, but if you do, then that's just saying you're working with a bigger number, like X is money, okay, or M is money. So if M is money, like M is mass in physics, okay, so M is money. So if you have more money, it doesn't change the fact of the equation, right? So M is money, and so M is mass and M is money, and you divide the mass by the amount of places the mass is going to go and the velocity of the mass, and then you start determining what's going to happen under different circumstances. So it's not the economics that's a science, it's the physics of things that we can see. There's only this much land, there's only this many shares of stock. Well, these things can vary. You can change those variables, but they're still there, they're still an equation. Okay? How many homes are there in the world? How many businesses are there in the world? How many shares of stock? What's the total value of that stock? How many treasury notes are there in the world? How much money has been printed in the world? How much is tied up in commodities? Blah, blah, blah. You see, there's a lot of stuff, but it's all something that you can account for. And if you pay attention, which is my job basically, is if you pay attention, you can get a pretty good idea of what's actually happening. And what's happening right now is completely unnatural because it makes no sense. It's not, and I don't mean makes no sense like I don't understand it. I mean, it makes no sense. There's no economic reason for you to give money to a government that's going to give you back 99% of your money. And it's not sustainable. People do it now because they think it's temporary, and they all have a plan to exit as soon as rates normalize. But, and by the way, with a bond, the only logical thing there is you're making a bet also, because if the rates go even lower, they go more negative, and you have a -1 bond, and they have -5 bonds, and your bond is worth more than their bonds. You're up like, the way it would work with a bond is you would be up if you have a 10-year note that's -1%, and the new 10-year note's -5%, then your 10-year note is now worth 40% more, 4% each year for 10 years. Your 10-year note is worth 40% more than the sucker who's buying a -5% note. So for him, he will buy your note. It's worth 140% of what he's paying for his note. So again, it's not that dynamic has to be accounted for in the overall equation, but these are all parts of the equation that you have to look at and say, how long can that be sustained? Ultimately, where does the money come from? Okay, if you look, if the only return in the world was negative, right? If all returns were negative, market returns were negative, and bank returns were negative, and everything was negative, but it just depended on how negative it was, which is where we're going with this sort of, plan that the Fed has. If everything is negative and just gets more and more negative, right? Which is what Japan is in now. That's what the deflationary cycle is. Everything's negative and it just gets cheaper. Their market gets cheaper, their stocks get cheaper, their utilities get cheaper, commodities get cheaper, food gets cheaper, everything's getting cheaper. But what happens eventually, the wealth that's been funding it will eventually drain out. You're not creating any new wealth, and eventually you run out. So there's an end to these things. They can't just go on forever. All right, so much for that rally. I guess somebody's listening to me. It's like, yeah, that's pretty bad, right? We're doing unprecedented things. There's not really much of a, there's not a lot of history to go back on because, nobody's ever tried this before. But, I'm extrapolating to some extent, but we don't think it's going to, I don't see how it can be sustained. I really don't. If it can be, I'll learn something new. But I don't see it. All right, back to questions. Let's see. Roy said, okay, we know about McLaren. What impact would a rate increase be expected to have on oil? The rate increase will strengthen the dollar, especially because nobody believes it's coming. The dollar is, look, the dollar's been here for the whole summer. The dollar's been here for the whole year, pretty much. Okay, so since 2015, this is where the dollar is, 95. All right, because this is when QE stopped. Or stopped growing. It didn't stop, of course. They stopped expanding it. That kind of put a brake on where the dollar is. And on the other countries also, everybody sort of took a breath and paused out here. But we are now the first country that's going to start tightening. And if we're tightening, our dollar gets stronger compared to other currencies. And you can see the other currencies. There's a monthly chart. You can see every other currency, except New Zealand's making a little comeback, but everyone's getting weaker against the dollar, basically. And the dollar is 20% stronger since 2014. And the euro is just about 20, what would that be, 28? Yep, 20% weaker. So the euro has dropped 20%, the yen 30%, the pound 20%, Canada's down about 20% plus. Even the Swiss, they can't keep their stuff together, but they're down about 20%. Aussies 20%. Everybody's down 20%, except New Zealand. They're holding together. Look at these guys. They've been up and down, but from 212, they're holding it together. So go New Zealand. All 12 of them can celebrate. Let's see. So, anyway, so the strong dollar is going to push oil low, is a factor pushing oil lower, but it doesn't by itself push oil lower. What's really moving oil is going to be whatever the Saudis end up doing. Well, the Saudis are OPEC. Well, really the Saudis, yeah, I'm sorry. I mean, honestly, what does it matter what OPEC does? It's really about what Saudi Arabia agrees to do. Close long? No, I wouldn't close the longs on the dollars. I'm essentially positive the dollar's going higher, and if it doesn't, I think the risk reward there. I don't think the dollar's going to go down much because what's the Fed going to do? They're not going to turn around and ease. They look like idiots, right? So they're either going to not do anything, stay flat, and leave everyone guessing, or they're going to tighten. If they tighten, dollar goes up. If they don't do anything, they haven't done anything for a year. So the dollar's not going to do anything most likely. I think it's almost a no-lose bet, frankly. I mean, again, we got in below 95. It's at what is it at? It's at 95.80 now, so it's not like I'm recommending everybody jump in and chase it. But I do think we're going to go up to probably 100. Doesn't the market historically go through the first? I don't think there's any historic ones. First of all, we had a Fed tightening earlier this year, remember? In December, we had a Fed tightening. So we did already have a Fed tightening, and the market did not go up. It went down. No. I hate that historical stuff, because right now, nobody thinks the Fed's going to tighten. Right now, the market is at all-time high. So how is it historical? Now, if you say, when the market's at all-time highs and the Fed is not expected to tighten, then historically we can see this is what happens. I would go for that. See, I would put a little bit of credence into that, because you're looking at the same condition. But you understand, when you just say, oh, the Fed tightened 8 times and here's what happened those 8 times, that tells you nothing about the other conditions that are present. I mean, it's like it's just mixing up. You're confusing the cause for what for your observations for what the cause is, causality, because you're not. You're sort of cherry picking a single factor, and there's so many factors affecting things, and every situation is different. You don't want to generalize stuff like that. When does Yellen start yapping? She yaps apparently right after the Fed. They say 2 o'clock. So essentially, now, the fact that they moved her up is another reason that they're probably tightening. Right? Because Yellen usually takes a half hour after the Fed. I think that she's getting on there because they expect everyone to freak out and they want to stop it as quickly as possible. So she's going to say, only this once, we don't expect to do it again, we're just testing the waters. Like, I got a feeling that's going to happen, and she'll come out and do that. But who knows? Well, I titled my article today, Wednesday Wipeout. BOJ and FOMC fail to please investors, market fall. That's my title for this morning. So you know where I stand. I'm pre-titling. I'm not even waiting for stuff to happen anymore. I'm just going to title my article a day ahead of time. Markets will indeed have a cow. That's true. Let's see. And those cows are going to get expensive because we're exporting meat to China again. Keep that in mind. Cattle futures are hard to buy. I mean, you have to. It's a whole specialty thing. Wall Street Journal. Fed raises by a quarter point a year. A year? No, that's not going to. A quarter point a year. Is that really what they say in the journal? That's idiotic. This is the thing. Everybody thinks that you can just leave rates at a ridiculous price. First of all, they are completely destroying the retirement savings of a generation of people. This is going on for years now. What, like 7 years of 0%? And it's not just the retirement savings of the people. There are companies like insurance companies that are obligated to put their money into bonds and things like that, and they've got to invest in whatever the going rate is. So those insurance companies who expected so the insurance company takes in X billions of dollars in insurance fees. They put it in reserves. The reserves then collect their fee, and the insurance company counts on those reserves to actually be their profits. They have payout percentages. This is important stuff. Everything is calculated like to the nickel practically. They don't count on getting 0% interest rates. They're not, it doesn't kill them immediately, but down the road it starts to really eat into these insurance companies. Not to mention all the retirement funds and different companies and the pension plans, and obviously the pension plans and everybody and the repercussions to everyone, the savers and everything. It's just a complete disaster. You can't just say, oh, let's do it another 5 years. It doesn't work. You don't feel the pain because not that many people have retired into it yet, but it gets worse and worse and worse. I really don't even know what people who live off interest do anymore. Even like billionaires, I never feel bad for billionaires. Even billionaires, like, what the hell do you do? They used to, a lot of billionaires who have their money in bonds, and they're used to getting like a 5% return, and you get 5% back on $1 billion is it $5 million or $50 million? $50 million, which is plenty to live on, right? You're a billionaire, you got $50 million a year to spend, that's fine. So a lot of old money billionaires are not that ambitious. They just put their money in something nice and stable and get their rates of return, and they live off that money. But now what happens when that money goes down to $10 million? Do you know what it's like to go from $50 million a year to $10 million a year? You got to give up the yacht. You got to give up the jet. You probably have to cut one of your homes. It's painful. It really is. I know people bitch about this kind of thing. Yeah, and so you're either going to do that or you're going to gamble your money, and that's the problem. That's what you end up gambling your money to try to maintain your lifestyle. But then, God forbid, you lose 10% of your money, which is $100 million. It's not worth it. So it takes a long time before they're really going to move to gamble that money. But if they don't gamble the money, it starts getting eaten away anyways to maintain their lifestyle. So that on a smaller scale is happening to everybody who's trying to retire. Any a good ETF to take advantage of rate hike? Yeah, we're short TLT. The Treasury ETF. That's an obvious one to me. I've been shorting it for a while, since about 140. 140 was our target. It worked out very well, actually. So 140 was our target. We took 2 stabs at it because timing-wise we didn't catch it right. So in the options opportunity portfolio, ooh, look at that, 106.5, baby. I like that. We have the TLT, and what we did is we bought the 140 puts. It's back on August 5th. We bought the 140 puts for $590, and we sold the 133 puts for $260. So what are we looking to happen? So from August 5th, when we were up here, all right, so right around, getting around close to 140, we took the I forgot already, the 140, 133. So we took a $7 spread. So we bought the 140 puts. We sold the C133 right here. So we sold the 133 puts. And anything below 133, which I was counting on to catch that 200-day moving average, anything below there, we collect $7 back on it. It's basically 100% return on our cash. Now, it's not that even exciting yet. Well, okay, it is. I'm sorry. It's up $1,000 right now. It's already up $1,000. The spread, and we only paid $3,300 in the first place. It's up 30% overall. So that's the way we play. Now it's at net 4,000, and it will be 7,000. So I'll tell you right now. Right now, you can pick up the spread for $4,000, and if all goes well, it's going to be $7,000. Not a bad way to play, frankly. Still, it's not as good as we got it, but it's still a good play. What's your take on Wells Fargo? Wells Fargo, first of all, they're being investigated. The CEO hasn't resigned yet. There's going to be a class action suit. There may be massive fines. Also, you see all these multi-billion-dollar fines going out. They haven't gotten hit with that yet. Nobody's going to do nothing about this. They ripped off millions of people, and it's fraud. In every count, it's fraud. You can't take that line down. So that hasn't changed yet. You also haven't seen the repercussions of, banks live and die on people opening up new accounts. Would you go to Wells Fargo right now and open up an account? You know, and you're a relatively informed citizen. What about the people who all they see is Wells Fargo rips you off, Wells Fargo makes fake accounts, Wells Fargo cheats? You know, that's all the, you know, so the vast majority of people who just open up normal savings accounts it's not like Wells Fargo has any kind of monopoly. I need to open an account. What about Wells Fargo? No. Let's go to the bank next door. I mean, I know in New York, I mean, literally you stare at 8 banks on a corner. Like you can stand on a street corner and there are literally 8 banks in your field of vision. And most places there's 2, 3, 4. I don't know any towns that don't have 3 or 4 different kinds of banks. So it's not like they're in any kind of position to win this fight. I don't think it's bad enough that people are going to withdraw their money from Wells Fargo. Well, no, I take that back. It's like, well, the people who have these fake accounts open up, because a lot of people aren't even aware this happened to them yet. But they will be, because what's going to happen is they're going to start getting letters from lawyers in the mail. You've seen class action lawsuit letters, right? They'll get letters in the mail saying, hey, you know, if you had accounts open in Wells Fargo between such and such a date, there's a very good chance that it's like this, and they're going to send the instructions to people for how to find out if you have fake accounts open in your name. And as Elizabeth Warren pointed out yesterday, it's not just the fact that they hit you up with fees. First of all, they are charging you fees and generating business on the account that's not there. So, you know, you don't notice it because they give you a combined account statement and it just says D, whatever. But Elizabeth Warren points out, you've impacted these people's credit scores. Now, if some lawyer proves that Wells Fargo impacted people's credit scores, millions of people, and 100,000 of those people ended up paying $100 a month more on their mortgage than they would have otherwise. Okay, so that's 100,000 times 10, $1 million a month. 100,000. Yeah, no, I'm sorry, it's $10 million. $10 million a month. So $100 a month extra because of your worst credit score. And that's probably generous. But $100 a month extra on just 100,000, so on 5% of the people, ended up taking a mortgage and got a worse credit score than they would have had otherwise, so they end up paying more for their mortgage than they otherwise would have. $100 a month, I mean, super conservative with the figure. You're talking about $10 million a month of excess money paid. So it's $100 million paid in 5 years, so it's $500 million right there, direct damages. That's using incredibly conservative figures. And then you've got to deal with the people who were turned down. Or what about people who say, I didn't get a job because my credit score was this, and it was one of the prerequisites in the job. And why did I get turned down? Because your freaking system, because credit scores looked at these accounts and said, why do you have 8 accounts? And I have 8 accounts because Wells Fargo opened 7 of them. It can get really ugly. So, no. So, I mean, you know, it's like buying BP the day after the oil spill and saying, oh, well, okay, so they had an oil spill, let's buy it. It didn't work that way, right? For 6 months, it grinded lower and lower and lower, and more stuff came out, and then the lawsuits came, and this and that. Then you buy it. Okay? Once it got ridiculously low, that's when we called the dead bottom on BP when that happened, because we waited and waited and waited and waited, and then it got ridiculous. You know, and then it was like everybody's suing everybody, and everybody's doing this and that, and it's like, great. And, yeah, Lumber Liquidators, too. Now, Lumber Liquidators, I came in too early. I'll admit that, because Lumber Liquidators was so stupid, I couldn't believe it would have legs. Because Lumber Liquidators was complete bullshit from day one. This is real. These guys did it. Lumber Liquidators, you know, BP did it. And these guys did it. Lumber Liquidators didn't do anything. They got attacked by a freaking hedge fund guy. Was it Ackman? Was that Ackman too? I can't. He's sickening. I think it was Ackman. All right, where are we? Oh wait, it's time? No, almost. Where are we? Okay, Wells Fargo. It should have said 8 years to do one. That's true. One per year is aggressive. VXX, I hate that ETF, but yeah, it's, yeah, I imagine so. Might get a little spark out of those guys. See, my attitude is I wait, see what happens, and then we'll see what the reaction is, and if the reaction turns out to be something we can play, we play it. If not, we don't play. It's a tough play to play. When you play on a very volatile thing like this, it's a very hard thing to play. How does beggaring the country economy to help the banksters? How does it help the banksters? Because well, like you say, beggaring. Right? Think about it. If people have no money, they need loans. If they need loans badly enough, they'll give up more to get those loans. They'll go more into debt. They'll give up more of their personal property. People liquidate their assets. All right? The whole scam of property ownership, going back to the Magna Carta, is, the government can't afford to pay higher interest, Liam, is a good point. But the whole scheme of the Magna Carta, going back to that time, is the government said, okay, the government said, the Lord said at the time, they said, okay, you guys want land, you're pissed off you don't own your land. You're working as peasant farmers and you're pissed off you want your land. Okay, fine. We'll give you the land. Not we'll give it to you, we'll sell it to you. So if you want your land here, we'll sell it to you. Have fun. So the lords and ladies sell their land to the peasants, but then they tax them on the land. Then they charge them for utilities. They charge them for, they find a million ways to make it not that pleasant that they own this land. Then, because when, these old money people, which obviously everybody was at the time, the noble class, they're all old money, that's the definition, they understand that there are economic cycles, and they don't worry about it. Sometimes it's good, sometimes it's bad, whatever. Okay? They don't panic in a downturn, but people panic. And what do? Whenever there's a recession, when there's, a recession back in the old days used to be just bad crops, and that's a recession, right? You have one season with bad crops, everybody's got no money, and it's a problem. Then they come back in and say, oh, you know what, I tell you what, I'll buy that land for you for for half of what I sold it to you for. So they come in and take the same money that the peasants gave them 10 years ago, they give them half of it back. Then when things get better, the peasants come back and they say, oh, we'd like to buy we want to buy land again because we want to own the property again. And they say, sure, double. And it just goes like that. So it turned out that was even a better scam than the one they used to have. That made them more money than letting people work their land and give them a percentage of the food they raised. It was way more profitable. Just took longer. But that's how rich people get richer. They have a longer view of things. So I try to teach you guys all the time to buy long-term spreads, to take long-term positions and rent it out to other idiots. Everybody wants to get rich quick, but you can get rich slowly so much easier. So you have to develop that longer-term view. But that's how it works because, when you create a situation in which everything is depressed, the banks know how to manage through. The banks will be able to manage and go through this thing. Not next quarter, not 2 quarters from now, not next year, but over the next 5 years and 10 years, they have plans. And those plans are going to be, we're going to buy these companies, we're going to merge this, we're going to crush, when they say we're going to crush this industry, like the way they spun real estate out, you wait and see what happens. They spun real estate out because they don't want it to take them down. They're going to let the real estate industry is going to hit a 20% correction on the price of housing. That's going to go down. That sector will go bust basically, but the banks are going to take them all freaking over. They're going to buy up all the properties. And then they buy up all the properties, and then when things do come back, they sell all the properties. It's very simple. And it happens all the time. In 1987, we had a massive savings and loan crisis in this country. Everything crashed. And we don't learn we don't learn though, because then 20 years later, boom, do it again. So now we're in the next phase. And 20 years from now, not 20 years from now, because now we're 10 years in, 10 more years from now, boom, another huge crash. That's a normal cycle, but in this particular cycle, the Fed reinflated everything and messed up the timing, so we'll just have to wait and see how this plays out. But the normal cycle is about 20 years, 20-year real estate cycle. I mean, any old-time real estate investor will probably be able to tell you that. You know, you just have to, if you prepare for it, it's not a problem. But what is it they say? If I only knew then, it's like when the old people always look back and they're like, oh man, because you see all the kids rushing in, all the flippers come back and blah, 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 and you look at them and you're like, oh, please. It's like I've seen this before. It's like me with Amazon. I watch everybody buying Amazon. I'm like, it's going to end in tears. I've seen it happen enough times. But, and Tesla too, things like that. It's like, it's sad. But you can't even if you try to tell people what's going to happen, they don't listen. So there's no point. It's a weird thing about getting old, man. You know stuff, but nobody listens. How about a bull call spread on BXX? I don't even want to get into it though. I don't like them. I don't like the way it works. I don't like the spreads. I don't like the poor trading. But yeah, fine. If that's why you want to play it, you want to play one that's for September. You want to play? Do they have weeklies? I don't even know if they have weeklies. Do they? See, now you got me looking at it. I don't approve of this playing the VXX myself. I don't like it. It's got crappy volume. It's got, I do have weekly. Look at that. So here you go. Bull call spread 3707. So what's your theory? Oh, here you go. You can buy the 37 calls for 120. Well, even better, you can buy the 3650s for 145. And you can sell these guys for 123, so that's like, 22 cents, and it's a 50-cent spread. And you got 2 days. So if your theory is right and the VIX goes up and stays up in 2 days, you'll make 100% back on your money. Very simple. So if you want to make it, if you want to make a play, that's the way to make a play. But, look, it's a coin flip, frankly. The Fed is so completely random. It's just, you may as well go bet on red in the casino. It's really not that much different. A bottom could occur when Trump does, they're still going to get sued. Tilson, that's right, Tilson, thank you. It wasn't Macklin. The other idiot. CBI is a $2 billion suit by GE over the nuclear assets they bought. Oh, I didn't know about that. Is this new? I don't know that. Well, that's a lot of money. July. Huh. Oh, I missed that. I got a bit. I don't know why. All right, I'm going to have to look into that because that's interesting. I could make that. Although, July. Yeah, okay, that's when it started. All right, but you know what? That's there. See, this is the kind of thing that CPI. Okay, so CBI is only a $4 billion company. Financials, $12 billion in revenues. Not well in a good year, $500 million in profit. So $2 billion would be very painful. Then it depends on whether or not the money is insured, and then you have to factor in how likely it is that's going to happen. But you know what? Even if it does happen, and they do end up having to pay it off, it's a finite thing. It ends at a certain point. So as a long-term investor, that's not the worst time to buy something. But that's we got to look into that and see how realistic it is. It's interesting, though. Facilities. President sold. They clinched a contract. They got a deal. CBI, second quarter financials. Maintenance. Newt. Here you go. CBI got landlord reports that the construction had sued Westinghouse, which claims CBI owes them $2 billion from the sale of its nuclear business. Litigation between CBI, okay, the company's former EPC consortium partner for U.S. nuclear projects highlights $2.4 billion difference in opinion on working capital adjustments. Wow, that's a big friction difference. Merits of Westinghouse appear to us as without merit, but the overhang returns to nuclear investor psyche. Derailing was supposed to be a cleaner story. Importantly, combine few fundamentals. Wow, I got to read up about this. This is cool. Right? This might make me like them more, though. Hang on. Right off a predetermined $1.2 billion working capital and outlines they're challenging the core premise of the deal. Westinghouse claims that. Well, now stop that. You're reading the. Unfortunately, it's. This is Baird's opinion. At Westinghouse claim appears wholly without merit. That's the opinion of Baird. Westinghouse is retroactively claiming agreed upon working capital. This is a hard claim to get. Was set too high and believe it owed $2 billion. By contrast, CBI claims Westinghouse owes $420. Wow. Okay. I wouldn't factor that in too highly, but I have to read more about it. That's really weird, though. All right, where are we? Set. Almost time. Okay. That was exciting. Wow, that's great. Thanks for bringing that up. That's really cool. All right, almost bedtime. Well, we need the TV because they get it before we do. Oh, it's so annoying to listen to. Anyway, so they've already got it, and they just can't talk about it until 2 o'clock. That's the way it works. So unfortunately, they're going to be ahead of us on that kind of thing. Comment on weekly oil inventory. Let me take a look at that too. Well, I don't want to get too into it. Okay, the petroleum status report. You always want to get the 1 o'clock PDF. That's the one that has the details. What the hell happened? $2,092 to $2,086. All other oils had a build. Crude in the SPR is flat, of course. Distillate had a build. Wow. Gasoline drawer and oil drawer. Now, refinery activity. Same refinery activity. Same gas production. Same distillate production. Product supplied. Same product supplied. Same everything supplied pretty much. Wow, look at exports kicked up though. Look at that. Petroleum products. So 400,000. So 2.8 million of the build is caused by us exporting an additional 400,000 barrels a day. That's one thing that strikes me right off the bat. And the imports are the same. So the imports were the same. We exported more. So that basically is a 400,000 gap here. It works out to 500,000, so that's not nothing. It's 500,000, so 3.5 million barrels less net imports for the week. That's one big effect there. So that's one reason why you shouldn't take that too seriously. So we had a decrease of 6.2 million. But still, there was some demand of gasoline and whatever. But remember last week there was a gigantic build. And so basically it's a mismatchy thing going on from the holidays, I think, when people stocked up. Some gas stations bought too much, and then they didn't buy any last week, and now they bought more this week. It's just a timing thing, I think. It'll probably even out after a point. Statement, how are we doing? Oh, 1 minute. Said decision. Oh, CNBC stopping everything. Somebody bet a lot of money on the VIX, he says. Here it comes. There it is. No change. The case has strengthened for a change in fund rate. They want further evidence. This is a weird-looking statement. Three dissenters. Wow. That's a lot of dissent. Three people dissented and wanted a hike. The overall statement says that they are leaning towards a hike, but not yet, and they want more evidence of strength. So let's see what it actually says here. Wow, I can't believe they totally changed the format. It's annoying. Household. Oh, wait. Let's go back to HTML. That's why. Sorry, my bad. Projections. Oh my God, I love projections. Okay, here we go. Picked up modest pace. Unemployment little change. Household spending. Committee's 2% objective. Partly inflation continues to run below. Earlier declines in energy prices. Market-based inflation. Compensation remains low. Most survey measures consistent with the mandate. Fed is blah blah blah. Inflation expected to remain low. The energy, energy won't drag it down anymore. It's funny because energy right now is dragging everything down too. We had another big drop in energy prices. Near-term risks are roughly balanced, continues closely monitor against this backdrop. Okay, they decide to maintain the fund rate at 1/4 to 0.5%. Committee judges that the case, here's the biggie. The case for an increase in the fund rate has strengthened, but they decided for the time being to wait for further evidence of progress. The stance of monetary policy is accommodated thereby supporting the thing. Okay, fine. And then we have voting against this were Esther George, Loretta Meester, and Eric Rosengren, all of whom have already said they think we should be hiking rates now. Future adjustments. Committee will assess, and they're looking for 2% inflation as usual. They're taking into account information. So if oil prices go up, that's going to get them towards their goal. Labor market conditions. So we want to look at jobs, we want to look at labor, blah, blah, blah. Okay. So it was actually what they said yesterday was that nuanced sort of thing. We were talking about it yesterday, how they were saying it would be N-U-A-N. Okay. So the Fed could take hawkish action without a rate hike, and he said that they would tweak it to nearly balanced, which they did. They actually said balanced, not even nearly balanced. I'm sorry, they didn't change that. Signaling a rate hike coming through. Then he sees the number of hawkish dissenters rising from 1 to 2 or 3. Good call by this guy. Let's listen to him next time. State Street. Finally, the dots will come closely in line to what the market is already pricing in. Expecting a cut, BMO thinks the tones from the Fed will be hawkish with no rate hike tomorrow. Very good call. Evercore says it's a hawkish hold. Means flat yield code headwinds to financials in the near term. Okay, that's all well and good. So meanwhile, the market is not reacting much, but it will, and it will go lower because this is not bullish. So now we do have an opportunity to do something about this. But let's take a look at the data now, see what's going on. So where is that thing? Fed. These things are fun. Economic projections. Changing GDP. 1.8% this year, 2% next year. That's not great. 2% the year after that. 2% the year after that. What are we, freaking China? Like, no, our GDP is the same every year with basically no variation. The June projection was higher. We've actually, see, look, we took a 10% haircut since June. Unemployment rate, no change in unemployment. Wow, these guys have zero variance in their models. PCE. See, this is funny. Here's reality. 1.3. Here's what we think will happen. It's really stupid. In June, we thought this was reality. It turned out reality was lower, but we didn't change any of our estimates going forward. Core inflation, same thing. Just, here's reality. Here's what we wish would happen. And the Fed funds rate. Now here, this is interesting. So 6 to 1.1, that's only a half-point hike next year. Wow, really? That's incredible. Wait, look at this. In June, they projected 9. They projected 9 for this year. Now they dropped to 6 because obviously they're not going to raise rates again. That kind of tells you they're planning on raising the rates in December, because it won't be enough to have an effect on where we are now, which is 0 to 5. 2.5 to 5. So even if they double it or raise it to 0.75, it's not going to have an impact because they're going to do it so late in the year. Next year, though, now we're going to be, if it says 0.6 here, it means we're going to start this year. See, here's where you start being detected. If we're going to raise rates here, it means we're going to start this year at 0.75. And if we're starting the year at 0.75 and one rate goes to 1, that means they're only looking at 2 hikes next year now. That is way, way, way below the dot plot. Then, if this year you're going to go from 1 to 1.5 to 1.25, you're starting this year 1.25, here's where they think they're going to start going rapidly up. Now, of course, that's the same nonsense because they've got the same goal, essentially, but now they just think they're starting lower and ramping it up later. So it's basically kicking the ball down the road. See, with 3, they think 3 is normal still. Wow, this is sad stuff, though. Median central tendencies, participants' assessments of proper model. Oh, that's interesting. The FOMC's participants, where they think proper policy is. So 10 people think 6.25 now. This is like dot plot except with numbers. 1.125 is next year. Then they go to 1.875. So these are really mild raises. Then 2.6, and then 3. It's really funny though. It's like, how do we get to 3? Really in a messed up way. That's cool. Okay, I like that. Anyway, so the bottom line is the longer term yield here is actually fairly low. Next year, they just radically downgraded from 1.6 to 1.1. They just cut out 2 hikes next year. And they're still saying it's data dependent. So that's interesting. My take on silver is that I still like it, but I don't think this is the best time. I still think the dollar is going to strengthen a bit. The dollar took a big plunge, though, based on what we just read. It was basically they have actually backed off. It's weird. They've got stronger language for raising rates, right? But at the same time, they've now on the figures that nobody talks about, but on the figures, they're actually bringing everything down. So yes, we're going to raise rates now, but in fact, that's what I thought was going to happen because Yellen, who hasn't come out yet, I thought she was going to come out and say we're one and done. But she didn't do that, but that's essentially what this says. It says we're going to be one and done. And there's going to be very, very little pressure to raise rates next year. Oil index raising R1's right. Let's see how that looks. There's nothing to get that excited about. We're just going to go back to where we like shorting it, I think. Could be wrong. We'll see. I mean, look, oil's up. Yeah, everything's up here. Oil's up. Natural gas. Oh, natural gas is over 3. Yeah, go Honey Badger. Holy crap. That trade of the year right there. Nikkei, even the Nikkei's happy, which makes no sense. Why is the Nikkei excited when the dollar's going lower? The dollar's really not that low. As I said, though, this is what we said. Even if the Fed doesn't raise, it's not going to drop the dollar much. But gold is acting like it dropped the dollar, and there's silver, too. Silver's popping back to 20. But you got some serious resistance here. You got it to 13.50 and 20. You got serious resistance on gold and silver, and the dollar shouldn't. And the dollar's going to have resistance trying to get below 95. So I wouldn't be jumping into either of these. I wouldn't be on the dollar, other than now you might get a chance to buy some. This will be interesting. I think the S&P at 2145 is an interesting short. The Russell. Now the Russell is a good one because they don't even like the small cap companies don't even like the weak dollar, so that's not good for them. And the Dow 1850 would be a good place to stop too. We'll see what happens. All right, so this is going to be worth sticking around for. Yeah, man, we saw a lot of activity on GDX. That was interesting. So apparently those guys knew something. Actually, somebody's buying the crap out of GDX. See, sometimes those volume things are worth looking at. Oh, index is up 20%. Fantastic. Wow. Yeah, somebody's talking about that, right, in chat? Rich, I think. It's a nice little gamble we were talking about in the chat the other day. Holy cow, look at that move. Nice. And look how far they have to go. You have any good news? Probably just the fact that they're going to go and try again. What happened here? Oh, this is them. Nope. True. Oh. Hang on, let's see what it says. Well, on the stars, well, June having a mass. It doesn't tell you anything. Okay, wait. So here's why they're gaining ground, and then everything it says is about how they failed to demonstrate efficacy in the fall. However, today they are up 10% as some investors probably consider the stock as oversold and start to buy on the dip. Well, that's a bit late. we were on top of that a lot earlier than these guys. All right. So those people are not calling it bottom; they're just jumping in when the thing moves. Which is fine. That's look, that's how we make our money, right? You make a fundamental bottom call, and then you go up. Now, I didn't like this. I thought it was a hell of a gamble. I liked it as a gamble, but I don't like it as an investment. It's a little too scary right now, but that's great. A nice move. Wall Street Journal has a tool to compare the. I like those things. Can I do that? Ew, I can't do that. Wait, open a new window. Here we go. Okay, what changed? They changed June to July. They changed, it has continued. Indicates the labor market strengthened. What's the difference between has continued to strengthen? Oh, they added has continued to strengthen. Okay. So last time it said has strengthened, now it says has continued to strengthen. And growth of economic activity, what did they? Has been expanding at a moderate rate. Now they say it picked up from the moderate rate. And although unemployment has little changed, the increase in labor utilization, cutting that because that hasn't been that great. I see. Look how they try to keep little pieces. In recent months, job gains have been solid on average. I'm always interested in these little changes. I think households have been growing strongly, but business investment has remained soft as opposed to has been soft. Okay. real nitpicky little changes here. The committee currently expects, no, they expect, if expect more than currently expects, more certainty to it. Expand moderate pace labor market. Wait. Labor market, oh, I see, conditions. They changed indicator to conditions. That's interesting. So, labor market indicator will strengthen, conditions will strengthen. I don't get that. Somewhat further. Wow, that's a weird change. That is near-term risks to the economic outlook have diminished or appear. Okay, so before they said it's diminished, risks have diminished. Now they say the risks appear balanced. That's weird. Okay. So, last time they were trying to say it got better than the time before, and now they're saying its risks are balanced. Okay. All right. And then they added this whole thing. The committee judges the case. This is a big thing, though. The committee judges the case for is coming, strengthening is coming, but for the time being, we're waiting, blah, blah, blah. And then that caused these two guys to object and say, how come we're not raising rates now? Okay, great. It's a very much a fortune cookie. You can read into it what you will. Thanks, Flash. That was useful. Why did you do it twice? I don't know. Gold and silver are reacting up. Yes. Okay. So now we can get up to the charts. That was fun, though. Oh, damn it. We hit my numbers. I hate having to do this at the same time, so it drives me crazy. Active trader. Okay. So where are we? Damn. It's 21.45 on the nose. I hope somebody made money on that. Oh. Come on, man. That's not fair. See, that's the problem, because when I said it, we should have started watching it, but I didn't want to, look, it's unfortunate because it's not the ideal way to be able to teach this stuff. I need like 8 screens to be able to show you what's going on. So as I said, though, we're going to go back and test the highs, and here's what we're doing. We tested the highs, and then we should start heading right back down because, frankly, there's nothing that great there. They're going to tighten, but they're going to tighten in a very slow, steady manner. Okay? So it's a carrot and sticky sort of thing. And that's fine. There's nothing wrong with that. But the point is, how does that help the market? How does that make things better? It doesn't. There's no additional stimulus. There's no change in the situation. It's the same old crap with a different kind of bow around it. And we're at a topping market. Things are drastically overvalued, and although the Fed is saying that the data is getting better, it's really not. We were talking about that in chat, but there's ways you can pick apart the jobs numbers and pick apart the other numbers and look at the inflation differently, and you see that inflation is higher than they say, jobs are lower than they say. We just had a bad home building report. Productivity is down. And that's the other thing. Okay, the economy can be going up. See, here's the thing. The economy can be going up, but that doesn't mean business profits going up. And when you're buying the stock market, you're not buying the economy, you're buying business profits. And those productivity numbers really strongly indicate that business profits are not going up at all. And business profits have been terrible. So the only good thing you can hang your hat on is Microsoft just said, hey, we'll buy $40 billion of our own stock. And by the way, what's Microsoft at today? I mean, that was a pretty big announcement yesterday. I mean, it's more than 10%. So Microsoft already up from 44 to 58 is what? Is 16. So that's up 44 to 68 is 16. It's up like 25% or so. 30%? No. Yeah, at least 30%. So they're up about 30% from last year. And now They're going to take $40 billion. Let's make sure I have these numbers right. I don't want to say the wrong thing. I think it's insane, but let's see.
September high. So remember that.
Oh, I hit it on the head. Wow.
So I think
I'm so good sometimes. So they're going to take 10% of their entire market cap, and they're going to buy their own stock because they have nothing better to do with $40 billion. They're making $16 billion a year. Is that a year? No. Yeah, that's a year. It's not, I'm stuck on Apple. I'm like, oh, they're making $16 billion a quarter? No, it's a year. Like, bro, what kind of bullshit is that? It takes them a whole year to make $16 billion. Apple's like laughing their ass off on this one. So they're making that much. Balance sheet. They've only got $6 billion here. Oh, they're $106 billion in investments. Holy crap! They buy a lot of stuff. That's what Apple's starting to do, though. What's Apple at? Apple's starting to buy a lot of people too. Oh, wait a minute. No, the balance sheet. Yeah, see, Apple's way lower than Microsoft in investments.
It's higher than when they hiked last time.
Stop that. Oh, it doesn't default to balance sheet, that's why. So look at Microsoft got way, that's why Apple's spending so much money on investments, because they're like miles behind Microsoft. And think about it, if it wasn't for investments, Yahoo would be a bankrupt company now. All of Yahoo's money in the last decade has come because they happened to buy Alibaba. You know, a couple other things that went well for them. But basically, it's like Alibaba was their whole thing. So down the road, even if Apple and Microsoft don't think they're going to fall apart like Yahoo did, they still see the value of having investments in up-and-coming companies. So, I'm sorry, so where were we? Oh, yeah, I remember what we were talking about. Saying, so Microsoft has tons of money sitting around, and they want to buy $40 billion in their own stock. Now, why do they want to do that? Because if you buy $40 billion worth of your own stock, then your earnings per share go up 10%. Makes everybody look very clever at Microsoft.
nothing to stop them.
You don't see the money moving around. Like Apple's had $200 billion for a few years now. If they bought 10% of their stock for $70 billion, you wouldn't notice it because they weren't using the $200 billion for anything anyway. But if they bought 10% of their stock, their earnings would pop 10%. That's what Microsoft's doing. But now here's the funny thing. They only have 1% on an announcement like that. That's how you know somebody's toppy. Not only are they toppy, but this doesn't make people happy. They could have given out a $40 billion dividend. They could have given everybody $5. I don't know if that would make people happy either. It's hard to say. I mean, it's a weird reaction. But that tells you a lot, though. It tells you how toppy the NASDAQ is when a company like Microsoft can announce a $40 billion buyback and it gets a shrug. How are we doing? Nope. Damn it. Ugh. I wanted to make those shorts. I'm so upset. All right. Well, I'm sad. What else is going on here? Go up. Here's oil, though. Oil. Now, I look at oil. I say, "Oh, I'd love to short it, but I wanted to, as I said earlier today, I want to short it 47.50, not 45. So God bless it. I wanted to go higher. Also, you have to consider that Asia is sleeping. They will wake up and they will see that our Fed, I don't even know what you call it. Our Fed is not hiking, didn't hike. That's the key thing here. Our Fed didn't hike. Not great for their currencies, but the perception will be it's good for the U.S. economy. All right, but it doesn't help them any. They would have liked a stronger dollar, and they're not getting it. So probably a bit of disappointment from Asia. this is going to be very much ruled by the OPEC meeting more so than anything else right now. So we had Japan did nothing today. Our Fed did nothing. Everybody's just standing around not knowing what to do. Gasoline, and it's interesting, right? Because here's the same 3 days in gasoline. Gasoline was 147, it's now 140. Oil was 44, now it's 45. So a long on gasoline off the 140 line, if you want to play something, is probably a good way to play. You keep tight stop below it, though. See, gold and silver, as we thought, is going to pull back a little bit. On the whole, though, it's very messy. But this is, look, it's disappointing. I mean, it really is. And I think now the selling will continue in the market. So it doesn't change anything, frankly, with the Fed statement. I thought at the time we'd get a sharp correction. We're not going to get a sharp correction, but there's nothing to stop us from drifting down lower. That's what I believe, anyway. All right, so what else is going on? Let's take a look at the news, see if anything else exciting is happening, and we'll read a couple of summaries. What do I do with that thing? Oh, where's the futures? How's coffee doing? Oh, that's a monthly. That was there. Hey. Here's coffee. All right. So coffee's actually doing very well. Just bad in the big picture. It's funny, you think it's doing great, you're like, oh, look at that big picture, it's ugly. And it is, you have to keep that in mind. There's nothing. 250 to not even 150 to 125 or something like that. It's a 50% drop. So the retrace is 25 points. So 150 is a weak bounce. 175 is our current target. That's a strong bounce on coffee. And that's what we're looking for. Sugar's been going really gangbusters too. Ours use everything. This is why, oh, by the way, we have DBA. In the portfolio, we have DBA. Well, let's take a quick look at this. So 5% portfolio chugging along, but we know it's chugging along because these positions, and we've added some, are going to make 118,000, or less now because when it was lower before. But these are going to make about $100,000 over the course of the next 14 months. So, we'll add some, we'll subtract some. We finally got rid of that Lebu position that was holding us back. Here's the coffee position that we took very recently. And look, the thing's only up $900 or something like that. But this spread, and again, when you go to the review and read this, you understand. This spread, we paid net 6 minus 4 is 2 minus 450. We paid net $1,500 for it, and the spread is long call, short call. So the spread is a $3 spread times 15 is $4,500 spread. So we paid $1,500 for a $4,500 spread. We expect to make $2,500 from it, and it's now $1,000 up. So we've made $1,000 of the $2,500 that we plan to make. That's all this stuff is. Here's DBA. We took that last month, okay? DBA is essentially flat, so still great for a new trade. And I really like this trade because, again, China, where is this? China. You have to remember the words they use. China beef. They don't call it meat, they call it beef. China beef. China to resume importing U.S. beef. Now, the premier said it. When the premier of China says something, it's going to happen. They don't make mistakes. It's not like Donald Trump is the premier of China. Okay, if he says it, it's because it's already done. So they're going to resume imports of U.S. beef, calling a sign Beijing's sincerity, blah, blah, blah. And he was in the United States. So it's one of the promises he made. He didn't give a timetable, blah, blah, blah. But anyway, so huge thing. And it's not a short-term thing. It's like you have to sit down the road. Well, what does that do? Well, cows eat grain. Corn is in the crapper. Soybeans flat. Oats down here. Wheat down here. Okay? So cows start munching on this stuff, and all of a sudden we're going to be in good shape, especially corn. So things will come back up. In fact, you can play corn long, too, because if well, corn is so low. If corn hit when at 300, I would have played corn long if I think of playing corn. But down here is a good spot to play corn long too. Wheat also above the 400 line. Wheat is a good play. That's a great play here, wheat. All right, so you look at things like that and think, well, what's that going to affect? Okay, and of course, obviously, cattle is going to go up. Okay, we're making this stuff for China. So so basically we fell to the 100 line. The situation has now changed, so the 100 line becomes great support for a move back up. And all that then is good for DVA. Which frankly, again, it's like I said, it got so cheap that we had to take a position. And we don't know when, but that's why we took a 2018 play. We don't know when it's going to turn around. But we expect it to turn around. In fact, we made a half a short here because we didn't expect it to turn around this quickly. So we're getting kind of close to where we bet that it wouldn't go higher. So we'll stop out of this. This would have been bonus money, but if DVA keeps going up, we're going to have to stop out of this at 75 and just get out of it. But meanwhile, it's a good little trade. What else have we done recently? We have this SJP, but that's not going anywhere. That's by the way, with the Fed not raising rates, that's probably a dead trade. We did the FQQ, that's a hedge. TCA is a hedge. The TLT we talked about before. The DVA we just talked about. Disney we adjusted. We're in that one. And by the way, people ask me about when's it a good time to make a new trade. Well, if we make an adjustment, then obviously we like the new positions. We just adjusted all these guys. So it doesn't matter if you weren't in it from the beginning. The fact of the matter is we like this current spread now. 9-1, who's that? Oh, Joe, that's coffee. We were talking about that. I like that. Kate is another good one. It's barely moved. It's up 375. That's another really good spread I like on that company. Leibu. Oh, you know what we didn't do? We didn't enter the new position. So this is missing a position, didn't we? I believe that we officially said we were going to add a March position, right? I think we did that. Here's good old lumber liquidators. We love them. That's already a mature trade. Marvel, already a big trade. SunPower. Oh, it's a loser. Look, we have a loser. Barely a loser, but it balances out. But SunPower not doing so well. Taser. Well, I don't have to worry about Taser. All right, so Taser is our stock of the decade. So here's stock of the year. Here's our stock of the year, UMG. This is our stock of the decade. So we're totally not worried about the stock of the decade. Even Twitter is making money now. Wow, no wonder this portfolio is up so much. What a great bunch of positions. And then we have Exxon. I forgot about those guys. They're fading out. All right, we'll have to make a decision on those guys too. Anyway, so that's the options opportunity portfolio, and holy crap, wow, that's like just banging along now. Really is doing well. The short-term portfolio, woo, that took a big hit. That just took a big hit. It's definitely down like $10,000 since the Fed. Well, we're wrong because we're bearish. So when you're wrong, you're not going to do well. We've been flat or down on this thing. Hang on a second. But the function of the short-term portfolio, which is now at $500,000, but it's up 400%. It started out $100,000. So the function of this portfolio is to protect this portfolio, the long-term portfolio. I mean, we do other, we take fun short-term positions in it, but the main job of it is to protect the long-term portfolio. The long-term portfolio, which started with $500,000, is up $500,000 basically. It's up more than $500,000. It's up 112%. This is the big daddy. This is the one we put our real money into. Okay, the other one is protection. Now, it just so happens that we've had such fabulous calls in the short terms that we made almost as much money, $500,000. We made almost as much money in the short-term portfolio as we did in the long-term portfolio, but that's not normal and not expected. In theory, we should have lost. If we made $500,000 in the long-term portfolio, we should have been very happy to get wiped out of the short-term portfolio and been up net $400,000, which would still be 80%. That's normal. We've had very, very abnormal times. And the abnormality has been caused by a lot of really good calls that went our way. Timing-wise especially. Like timing-wise, we got out at the bottoms and we got in at the tops and we doubled down when we had to, and it was gangbusters for a long time. But that's not how it's supposed to work. It's supposed to work that the long-term portfolio grinds out a profit and the short-term portfolio loses money protecting it. That's normal. So what we're doing now is what's normal. Is we've been having pretty good last few months of the long-term portfolio, but the short-term portfolio has lost a bit of ground. But none of that is anything to complain about, of course. In the long-term portfolio, we just sold these Monsantos. We just sold, who else is 16? We just sold these Cliffs. What? Did we? Oh, I see. We sold these 2019 CLFs. We sold these GNCs recently. They're up a bit, but not so much. We sold IMAX recently. Another one. All these are ones we'd love to buy if they ever get cheaper. Monsanto. Schnitzel must be doing great, right? Yeah, they're up 62% already. Here's SKX. See, now that's down, so that's actually a better price now than it was when we sold it. And what do? We sold the January 25 puts for $5, so our net is $20. And it's just around 20 now, so it's actually better now than it was. Here's Silver Wheaton. We like them. But that one's dead. That one's done. Wow. Silver was so cheap when we did this put. We sold the $15 puts for $5. So we netted 10 on this thing. These things are down to 83 cents, and we're up 82% on those. Those are great. Here's more SunPower. How do we have more SunPower? Holy cow. It's just a different portfolio, really. Oh, here's Teva. We just did Teva. Oh, I have two entries. Oh, I made a mistake. One of these has to be deleted. We shouldn't have two. We double-entered Teva. Target Cedro. Then we have our dividend payers in this section. And then down here are all the spreads of things that we actually took positions on. And here's how it works in the long-term portfolio, okay? Generally, we sell a put. And the put says, I will buy this stock. I will buy Monsanto. It's $11.50 below 100. So for $88.50, I will buy Monsanto. That's what we're saying when we sell this put. If it isn't 88, if it doesn't go below that, we'll make money on the short put. If it does go to that price, we'll start our position on Monsanto at 88. Then we drop it down here. Now, if Monsanto's a dividend payer, it drops down to here. And if Monsanto's not a dividend payer, we'll generally set up a spread and put it here. And that's how we build our long-term portfolio. It all starts with selling that put. And we've got videos on the subject, how to buy a stock for a discount is video number 1 in our series. And the way you buy a stock for a discount is you sell a put on a stock you like. It's like, I like that stock. I look at Monsanto. They're getting bought, don't forget. So I say, I like Monsanto, but I'd like them more if they were $90. So I'll promise to buy them at 90. I'm not buying them now, but I'll promise to buy them if they go back down to 90. Then I don't mind initiating a position. Because even if their deal falls through, and here's a longer-term chart, even if their deal falls through, 90 is pretty good support for these guys. All right, and not just technically, they also make enough money to cover it. That's how we look at these things in the long-term portfolio. Then we've got, that's a lot of portfolios. So the butterfly portfolio, dun, 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 dun. Oh, only up 186%. Sorry. Oh, this one's doing good too. Same concept. And because in the butterfly portfolio, we always are selling, not always, but we always try to sell those front month premiums. So we'll take a long position, and the main reason we're taking a long position is to sell short-term premium against the long positions. So all this is we're playing the be the house game. That's what this is. We're playing. We buy the casino. We then invite people to come play. We tell other people, hey, you want to bet our stock's going up or down? Go right ahead. We'll take your money. We'll take money from a guy who bets it up, and we'll take money from a guy who bets it down. We'll give both of them crappy odds, and most of the time we'll make a profit. Oh, that's talking and drinking. Damn. Sorry about that. I just totally inhaled my tea. Sorry. Oh, Yellen's talking now. Damn. That's bad. I breathed it right in. All right, so what was I saying? Oh, so yeah, this portfolio is so simple, and look at that margin requirement. We're not using any margin at all to run this portfolio. It's freaking fantastic. And why is that? You see this net total market value, $11,000. Everything's balanced out. Everything. We don't have any open short calls or open puts that aren't covered by other things really right now. This is still my favorite portfolio. You know, it gives you no trouble at all. We only touch it once a month, if that. Not even once a month. I think we made 2 adjustments in the last cycle, and it almost never is in trouble. Not almost never. I don't think the thing's ever been in trouble the entire time we've had it. and we always have a butterfly portfolio. So before they say there was one before it, one before that, one before that. I think the only time we ever had a problem with it was back in the big crash. Damn. Cannot believe that. When I was talking, I tried to drink something, and it went, and I guess I inhaled it right at the same time, and it went right down into my lungs. So I got this whole drowning in tea thing going on. All right. So I suppose this will be a good time to end the seminar, and I'll see if I can somehow recover. So Yellen's saying stuff and encouraging people. Business investment is still soft, she says. See if we can get a tweet thing going. Tweet. Oh, I don't have Twitter up. Sorry. Hang on, I'll tell you on the other computer. 2 to 3 years to get to inflation. But now, don't forget, the inflation target is 2%. It's going to take us 2 to 3 years to get to 2%. They're pleased with how the economy is doing. So this is not bullish, because if they're pleased with the economy, it means they're not going to do anything to fix it. They only expect to warrant gradual fixes over time. They see evidence of the economy expanding more strongly. Definite evidence of the economy expanding more strongly, they say. And the lack of inflation, so in other words, oil prices going down are the main reason that they didn't hike. That's what she's saying. So those dailies. So between the last meeting and now, oil is down 10%, and that's why they didn't hike. So that caused a fair degree of deflation. All right, so there we are. Okay, so basically it doesn't change my premise. We are getting a chance now to short back at our numbers. We're coming up. So I would love to short these red lines. If we can hit this red line here, 48.30, let's say, on the NASDAQ, I'd like that. 45 on the S&P, 150, of course, on the Dow, and 235. These are the same numbers we had this morning on the Russell. These are all good shorting lines. So we'll see what happens. Now, tight stops above them, because if we're going to keep rallying, then we just got to let it go. But we'll see what happens. All right, well, I'm going to go get my lungs pumped out, get the tea out somehow. Maybe a blow dryer or something, I don't know. See any other questions? Do you like short on cotton? No, why would I short cotton? No, I like all. I think I like all agriculture right now. I think it's gotten beaten up for no good reason. Lebu March options aren't trading. Oh, is that why we didn't do it yet? Okay. Well, then we got to wait for them to actually start trading. But I do want to do those Lebu. I want to do another Lebu spread in March. Same kind of spread if if we don't get around to it. But when the March does stop trading, please remind me, and I'll set up a top trade for it. All right. Oh, I'm getting better already. Great. Okay, guys. Have a lovely, lovely week, and we will see you again next week. All right? Thanks so much.